the Teaching Tax Flow podcast, where the goal is to empower and educate you to legally and ethically minimize taxes paid over your lifetime.
Welcome back to the podcast, everybody. Today, episode 61, we are going to have a great show where we look at, for the first time ever, I believe the first time ever we've ever even dove into this at all, it's the used clean vehicle tax credit. That's right, it's for personal use, but used, sometimes referred to as pre-owned, clean vehicle tax credit. So what does that mean? You're about to find out. But before we do that, let's take a moment as always and thank our sponsor.
This podcast is brought to you by Strategic Associates. Are you a high-income earner, real estate investor, or successful entrepreneur who is frustrated by having to pay $75,000 or more of annual tax liability? If so, Strategic Associates can help. Your first step to saving thousands, if not hundreds of thousands, is to contact Roger Roundy at roger@strategicag.net or by calling 801-641-2956 and be sure to tell him TTF sent you.
Obviously, you've seen it in the show title, you read it in the description, you heard it in the intro, but I'm going to reiterate it. Today, we're talking about used clean vehicle credits. That's right, used clean vehicle, used cars, previously owned, new to you, whatever you want to call these things. We're talking about clean vehicles. So that's your EVs, your Teslas, your, I guess, hybrids. Maybe we'll talk a little bit about it here. I don't know if that qualifies, but I'm bringing on the man, as always, that has all the answers to all my ridiculous questions at times. So, Chris Picciero, welcome back to the show, my man. What's happening?
Oh, it's great to be back. And, well, John, you might have some crazy questions once in a while. Yet, the answer to almost all the questions in the tax world is, it depends.
Ooh,
right?
That's like asking somebody on a date and they're like, can I get back to you a little bit? But I get it. It makes sense, right? Everybody's situation's different. So this topic I'm personally excited about. Obviously, I mean, you're from Michigan too. So we see, vehicles, new, old, and everything in between kind of rolling around the streets. Chris, I don't even know if you know this about me. I know we always share a lot of weird stuff, but I actually went to college for one of my first college degrees on upper engine performance. So literally to rebuild cylinder heads and intake manifolds for race cars. I don't know if you knew that.
I didn't know that, and that's very interesting. You're an enigma, and
it's better than an annoyance.
We have from what I've heard, a pretty prestigious school in the automotive world here in Nashville, called Nashville Auto Diesel College. This is what I'm saying. This is what I've heard. So I can imagine a clean vehicle just meant that you actually got a detail. And that that would qualify for that. Would be nice.
I know my wife doesn't listen to this, but I wish she did that every once in a while. I take the leaf blower to and blow out the kid Cheerios. There you go. There's our clean vehicle. But so this topic is really interesting to me, right? Because it almost, I won't get into all the details. Obviously, we'll do this with some form of format, but it's very interesting because now we're talking about used clean vehicles. So if I say EVs instead of clean vehicles, we're not just pigeonholing EVs, but now these have been out in the market for some time, right? So the opportunity now to purchase a used one now is an option for people where, I remember when Tesla was just getting fired up, using that for one example, and there were no used ones out there because everybody could only find new ones, right? So Chris, to you, at first glance as a CPA, tell us a little bit about this, and then I know there's some caveats, if we will, within this new credit from the IRS. So give us kind of your overview on what we're looking at here with this.
Well, there are some caveats, and to set the stage, there has been a clean vehicle. There's some interchangeable terminology, but let's just say clean vehicle for purposes of vehicles that are either electric or hybrid. There's been a credit for those vehicles for quite a few years, but it was always limited to new vehicles, and there was limitations based on how many were manufactured. Starting here in 2023, under the Inflation Reduction Act, a lot of those things changed. We have a new clean vehicle credit. We have a new commercial clean vehicle credit. And guess what, guys? We'll do some podcasts on those in the new year. So I know you're at the edge of your seat for those. But we wanted to escalate the used clean vehicle credit because this is the first time taxpayers are eligible to receive a federal tax credit for purchasing a used vehicle. You're going to hear, previously owned out there, but we're just going to use the term used. So beginning January 1st of 2023, if you buy a qualified used electric vehicle or fuel cell vehicle from a licensed dealer for $25,000 or less, you might be eligible for this tax credit. The credit is 30% of the sale price with a maximum credit of up to $4,000. So what that means, John, is if, let's say you bought an eligible EV and it was $20,000, 30% of $20,000 is is $6,000. I'm not good with numbers, John. By the way, whenever I play pickleball, you knew it had to come up. I usually
there it is
wrong at one point in the game because I'm a little bit of an intense player. And my running joke is, sorry, I'm not good with numbers. Now, my friends that I play with know I'm an accountant and they just chuckle it off or they roll their eyes and say it's a dad joke. But for people that don't know me, they're like, yeah, I understand. And I just, but
it's like, oh man.
So the credit would be $6,000, 30% times $20,000, yet the maximum credit would be $4,000. So you would be eligible for a $4,000 credit, but there are some limitations. It's because that is a non-refundable credit.
And so, Chris, really, it's, if we pump the brakes, pun intended. There's my dad joke. I don't have a pickleball joke, but I do have that one. So basically what you're saying here so far is that, and this is only for households, so for personal use, right? This is not for businesses at all that we know of. Is that correct? Or is that one thing that's still kind of out there?
Well, this credit under IRC, Internal Revenue Code Section 25E, is for personal use clean vehicle credit, or used clean vehicles. Remember, there is a new commercial vehicle credit. Now, that doesn't mean the vehicle that you purchase as a personal vehicle couldn't have a portion of business use. So maybe you're a freelance, maybe you have some business miles and you drive a couple thousand miles, you freelance and you have home office deduction, you have 1,000 miles or 500 miles. You can still take the mileage deduction. But this is a credit for a personal used vehicle. Now, I mentioned
actually what you just said there. This is how your brain works, and I know it, right? Like, you just said something really important that you probably didn't even realize how many people that appeals to. And really what you said there, right, is there is a difference between really who the vehicle's registered to. If it's registered to a business, if it's registered to an individual. But I won't, maybe it's a loophole. I don't know if that's the right term for it. But like you just mentioned there, if you're able to take the mileage on that appeals to a whole nother audience, right? So I know you just kind of rattle these things off and that's how your brain's ticking. Things are just coming out. But I think that's a great point to make. And I wanted to reiterate that just so people understand that for, say, self-employed.
Right, exactly. So if you're self-employed and you buy a used clean vehicle and it's in your personal name and it's a personal use vehicle, there might be some business use. You can still be eligible for this credit. Now, that's where it gets tricky because the credit is non-refundable. And I'm sure everyone listening to this podcast already listened to our podcast about solar credits and how home efficiency.
Of course I did.
But just in case you didn't, what that means is that a non-refundable credit only applies if there's an actual tax due. So if your total, so John, let's say you bought the $10,000 or $20,000 vehicle, multiply that by 30% is $6,000. The maximum credit's $4,000, but your tax is $3,000. Then you can only use $3,000 of the $4,000, meaning this vehicle credit can't be more than your actual federal income tax, but it can wipe it out. That's what non-refundable means.
So really, this is pretty limiting for the most part on who could really take advantage of this too. And then also, something else you mentioned there earlier on that's pretty important is it has to be from a licensed dealer. You can't be on Facebook Marketplace, buy a used vehicle that's 19 grand. Like, it has to come from a licensed dealer, not a private seller, correct?
Correct. So let's talk about we're going to talk about what the qualified vehicle and sale looks like. Then we will shift gears.
Ooh, okay.
Talk about who qualifies. So
I like it.
The sale has to qualify, and the purchaser has to qualify. So let's talk about the actual vehicle. The vehicle has to have a sale price of $25,000 or less, and that includes all dealer-imposed costs or fees not required by law. If it doesn't include a cost or fee required by law, such as taxes or title or registration. So it doesn't include sales tax, title, and registration. So the point is, if the sale price is $26,000, but $3,000 was title and registration fees required by law, you still qualify. The vehicle has to be a model year at least 2 years earlier than the calendar year when you buy it. So the IRS uses the example. A vehicle purchased in 2023 would need to be a model year 2021 or older. The vehicle had not already been transferred after August 16th, 2022 to a qualified buyer. The vehicle must have a gross weight rating of less than 14,000 pounds. It has to be an eligible plug-in EV with a battery capacity of at least 7 kilowatts, which, again, we're not trying to get too technical on this podcast, and it has to be primarily used in the United States. The point is, the dealer, and Jenny made a good point, it has to be purchased from a dealer. It can't be purchased, John, from your cousin Vinny.
I wouldn't. If I had a cousin Vinny, I don't know if I'd trust him anyways. Said if I did have a cousin Vinny, I don't know if I'd trust him anyways.
I probably
might be selling an EV without a battery or something. Who knows?
Well, so the vehicle has to come from a dealer, and the dealer reports that sale to the IRS. So the IRS is going to have some type of report to match up, most likely the VIN number and your social security number. If you're concerned about, do you have a vehicle that qualifies, the dealer is going to know, not that all the dealers are the most trustworthy individuals in the world. You can go to fueleconomy.gov and check to see if the vehicle you're going to purchase is eligible. And John, we're going to put a link to that in the podcast notes.
Absolutely. And as as the IRS starts to rev up, here's another one of my dad jokes.
Yeah.
Rev this up a little bit, and the market, we won't necessarily say would ever become saturated with vehicles that would qualify for this, but again, as we mentioned a little bit earlier, and we got into a bit, there are these limiting factors. I mean, this is coming from a gearhead, like myself, is I'm literally pulling this out of the air, so there is no, please don't fact check me because I already know that I'm going to be wrong here. But thinking of a Tesla, for example, I believe that the average lifespan of a battery in those is about 7, 8, 9 years. So, I mean, of course, we're getting past the 3-year here, but the cost of replacement is very significant. If I remember right, we had a buddy down south who I want to say they spent like $7,000 or $8,000, maybe even more, out of pocket just to replace a high mileage battery on one from our earlier years. So, kind of consider that, right? If you're weigh your options. I think when approaching this is the credit worth it? But obviously looking at potential repair costs based on that, because it is. I mean, I could tell you another example. Somebody gets in a fender bender with, not to talk about Teslas all day long, but I know there's an example. They waited over a year for a new bumper because there's no parts
right
for them. So there's considerations to be made.
And that's why for the right buyer, we talk about, in teaching tax flow, the 3 laws. Tax laws are going to encourage and discourage certain behavior because tax agencies are your involuntary business partner. The intent of this law is to help and encourage certain segments of society to buy an electric vehicle. Maybe those are people that couldn't afford to buy a brand new EV, hence the $25,000 or less sales price. challenge is there aren't that many vehicles, $25,000 or less, that are 3-4 years older. So now you're looking at a much older vehicle that might have some deferred maintenance, like you're mentioning.
So and hopefully as time passes by, right, they would, hopefully, oh man, I'm full of jokes here. I just thought of another one. As the IRS may go the extra mile, and with this, maybe they'll open it up or realize, kind of the implications of this. But I know we talked previously, right? Like these factors, again, is not meant for everybody. It's all public information. So everything we're talking about out there, it's an easy reference. Obviously you can fact check that. But I know Chris, you had some other, other components of this
Absolutely.
that we need to definitely go into.
And that's something to consider. We're not sitting here, again, with this tax credit and some of the continuing education classes that I was instructing for other accountants, we kind of made the joke that this credit's a little bit of all hat and no cattle. That being said, shout out to our friends at the Wildlife Partners, by the way. Not that they have cattle, though, but they have some wicked hats.
And they're just really great people. I love those.
Well, man, they are. But the thing is, this credit's going to be around for the next 10 years. So although we might not see a lot of 2023 credit claims, we think that this is a long play looking at the quality and longevity of these vehicles. So a vehicle that's 4 or 5 years old that you're purchasing in 2029 is probably going to come in with less deferred maintenance than a 3, 4, 5-year-old EV right now, but due with technology. So the positive here is this is a credit that's going to be around, for the next 10 years. It goes all the way to December 31st, 2032. Now let's talk briefly about who qualifies, okay? Because you've got the type of vehicle, type of transaction. The last hurdle is going to be who's going to qualify for this. And you must be the following, John. You must be an individual who bought the vehicle for use and not resale. So this isn't someone that buys and flips vehicles. What this is saying is if you're in the business of reselling vehicles, this is not a credit for you. You can't be the original owner, hence the used vehicle. You can't be claimed as a dependent on another person's return. And this gets tricky because a lot of times when we start looking at the other qualifications, when we look at income, imagine you're a parent, your child's, going off to college, 18, 19 years old. You'd like to buy them a modest vehicle. You'd like it to be electric. And you're thinking, well, why don't we just have the child buy the vehicle since they're going to be under the income threshold that I'm going to talk about in a moment. And that makes sense, right? That's good tax planning. Hey, have the child buy it, not the parent. Put in the child's name. But guess what? You can't be a dependent on another person's return. So now that you're disqualified. And you can't have claimed this credit at any time in the last 3 years. Hopefully, when you buy a used EV, it's going to last you more than 3 years anyway. That's the hope.
Right. That's the goal. That is the goal.
I'm gonna wrap up by talking about the modified adjusted gross income restrictions, meaning this is the real tough part if you haven't thought this is tough already. If you're over a certain income threshold, you're ineligible for this credit. And this is what's called a cliff, meaning some tax credits, like child tax credit, they phase out with certain income, earned income credit. This is a cliff. If you go over the cliff, boom, you get nothing. So your modified adjusted gross income, which is typically your AGI or adjusted gross income, for married, filing joint, or surviving spouses can't exceed $150,000 to be eligible. For head of household, it can't go over $112,500, and for all other filers, which would be married, filing joint, or separately, single, $75,000. So those are pretty low minimums or maximums. The good thing is you could use your modified AGI from the year you take delivery of the vehicle or the year before, whichever is less. So that's a positive because let's face it, John, not too many people that make under $75,000 are running around buying a $20,000 used EV.
Right.
It just doesn't make, and if they are at that point and they have dependents, they might not even have much tax to pay. And that's where, I think could be a very valuable credit. I think it's going to be used down the road as the years go on. I hope it gets expanded upon for the consumer. But this credit, as we dove into it, and many of our tax professionals agree, again, to use that all hat, no cattle, it might be some type of propaganda by the government to say, look, we care about, sustainability, we care about being green, so we pass this credit that basically not many people are going to be eligible for, and even if they are eligible, it's a non-refundable credit, and the people that are eligible probably don't pay that much in tax anyway. Not to poo-poo the credit, but I just don't want people in the teaching tax flow community, and again, we've had a lot of people reach out about this through our different channels, going in assuming I'm just going to get a $4,000 credit because that's what I heard.
Right. And that's actually, Chris, when you mentioned that, it's, some time ago, I mean, this could even be 5 years ago or so. I remember, I think the Chevy Volt was a big one. And again, don't fact check me on this one, but I feel like it came out that some dealers were using that as part of their advertising and their marketing, that there's credits, and they misworded it, we should say. And kind of it was implied that it's also on lease vehicles, which we won't get into. But that's not the case, because it's never, a lease vehicle is never truly deeded, if we will, registered to you as an individual. So obviously it's a whole other thing. So that was interesting, I remember. But as far as for everything we have here, I mean, there are some limitations that we ran through. The good thing is that they're pretty cut and dry what they are. It's just obviously who qualifies for them. You got to check the right boxes and all the boxes, and not some of the other ones. So I promise, Chris, this is my last joke about us. I'm glad we took a look under the hood, or I should say the frunk instead of hood, because true EVs have front trunks. And anyways.
Well,
any closing notes on this?
Yeah, the final thing I want to mention, and we'll put this in the show notes as well, to claim this credit, you're just going to file a Form 8936, or your tax professional is going to help you out with it. And in my last piece of advice is, before you purchase a vehicle, just make sure and if you think it's going to be eligible, make sure it is, and feel free to reach out to us here at Teaching Tax Flow or in our channels, and we're happy to help.
Absolutely. Well, thanks, Chris, for diving into this with us. Everybody for listening on this. Again, great topic that we dove into, something a little bit different than normal. I mean, I'm sure a lot of people expected us to talk about, business deductions with vehicles. This one's great because we get into the personal side of it. But then also we will drop those links in there. You can click on them. Please follow along. Any questions, reach out with those. But until that, you reach out if you have questions. We're here if you need us. We will see you same place, same time here on the Teaching Tax Flow podcast next week. Thank you to everybody for hanging out with us here on this episode of the Teaching Tax Flow podcast. I'm sure you have questions about this, as we all did the first time we seen it. Again, this is just an update from our team to our community members. Lots of information to come with this, or I should say results or outcomes, we should say, of the IRS offering this here in years to come as well. But as promised, we did drop some links in the show notes for references, for some forms, a lot of stuff that Chris and I discussed. We actually put in those notes you can take a peek at your leisure if you have any questions. And until then, always feel free to drop us a line, email, Facebook message, wherever you choose. But don't forget to join the Defeating Taxes private Facebook group page. It's free, no cost, no obligations. Just join it. It's where our community is most active. We look forward to seeing you there on that group. And back here again next week, as always, on the Teaching Tax Flow podcast.
The content of this podcast does not constitute an offer of securities. Offerings can only be made through an offering memorandum, and you should carefully examine the risk factors and other information contained in the memorandum. The content provided is for educational purposes only. We encourage you to seek personalized investment advice from your financial professional. For all tax and legal advice, please consult your CPA or attorney. Investment advisory services are offered through Cabin Advisors, a registered investment advisor. Securities are offered through Cabin Securities, a registered broker-dealer.